Good evening, and nice to connect again with Taxmann on this interesting subject of real estate sector. I'm trying to give you different perspectives on some of the issues which are faced by some of these companies across the country. So, since it's about a 1 hour slot, without much ado, I'll go straight into the presentation. So today, if you look at a developer, he has to make GST payments to vendors. Then there is GST on RCM, reverse charge basis. He has to make certain payments, whether you call it RCM on development rights or 80-20 formula and shortfall. Then you have GST on construction for the customer, then GST on construction for the landowner, then ITC reversals in the case of completion certificate. So it's a huge burden which the sector actually goes through. So the purpose of this 1 hour session would be to explore some options and also look at whether these interpretations are still possible or not. The first challenge in GST in construction is that 1499/2019 changed everything. In the sense that if you're a real estate developer and if you're a residential project developer, then from 1419, you were caught in a situation of notification 3/19, which told you that you have literally no option but to pay 5% GST. 5% is the effective rate. It's actually 7.5% is the GST rate, and 1/3 is deducted towards land, and therefore it's called 5%. So the total consideration, you pay 5% GST, no ITC. You cannot claim any ITC in the transaction. And you had certain conditions that 80% of your procurements must come from registered suppliers, failing which, if there is a shortfall, there are certain consequences, and including if you buy cement from an unregistered supplier, there were certain consequences. So it's actually a very huge burden. It was thought of as a solution to make real estate cheaper, but it didn't work out for the simple reason that if you cannot claim ITC, your cost goes up. And if you're a real estate developer, your cement is at 28%, which is a significant component of your cost, and therefore it's a huge cost that spirals into your ultimate selling price. And even though the rate appears to be comfortable at 5%, that 5% is on a higher selling price because of all these factors. So let's look at the option of a developer paying GST at 18% on the construction consideration, and for taking a position that no GST is payable on the sale of the land, and avail ITC in respect of the input services, etc., used for construction services. Is this option possible? If you look at 3/19, it amended 11/17. And if you look at 11/17 very carefully, it is issued in exercise of powers available under 9(1), 11(1), 15(5), and 16(1). Now, 9(1), all of us know that it is the power to levy GST at various rates that are notified. So it's just the power to notify rates. 11 is the power to grant exemption. 15(5) is the power to determine value. And 16(1) talks about condition restriction as may be prescribed. ITC is available. The power to notify rates is a simple power, and there is no power in section 9(1) to specify conditions. If you look at 3/2019 as a notification, it is split into various columns. And if you look at the effective rate of 5% column, the next column is bundled conditions. There are so many conditions that are specified in that particular category, which means that it seems to be married with the rate of tax. But if you look at 9(1), 9(1) simply is vanilla rates to be notified. There is no conditions or restriction that can be stipulated. On the other hand, the power to grant exemption is completely different. So power to grant exemption in terms of section 11 has got certain categories where you can say that the exemption can be absolute, the exemption can be conditional, the exemption can be subject to various restrictions. So one key point that flows across is A, non-availability of ITC. Where should you say that? You can say that only in 17(5). You cannot say through a notification. Or at least in 17(5), there must be a link to this particular notification. It doesn't exist. Section 16(1) does not confer any power to deny credit. It only talks about eligibility to credit. 15(5) requires rules to be framed for valuation in respect of notified supplies, and that rules has not happened. And the peculiar thing is that in the part of 3/2019 amendment, the entry for supply of works contract service itself was deleted. Entry 3, clause 2 was completely deleted. And you have a residual entry which refers to construction services other than what was specified above. So one can probably take a stand that the lower rate with conditions is more like a concession through an exemption notification rather than a rate of tax. So it's like a exemption from the parent rate to a lower rate subject to ABCD conditions. So 5% is the effective rate, is a lower rate flowing from section 11 with conditions, and the conditions are that you cannot avail ITC, etc. And the law is very clear, it's well settled that if an exemption is absolute, you have to follow the exemption. If the exemption is conditional, you have the option not to avail the exemption. Therefore, once it's a conditional exemption saying that this lower rate is subject to ABC conditions, by not following those conditions, the rate automatically goes up to the higher rate. So one can choose to interpret on this angle and take a position that GST at 18% is possible with ITC as a eligibility. Now, let us say you take such a position and you're tested. And if you're tested, what can go wrong? Somebody can come to you and say that, look, you've availed ITC. And therefore, since ITC you have availed, 5% is not eligible for you. 5% is not available for you. If 5% is not available for you, what happens? Only 18 comes. So even the consequence of proceedings, let us assume a bona fide developer, a person who does not want to do interpretation or anything like that, he has followed the 5% scheme, but he has wrongly understood the 5% scheme and he has availed some ITC on some of the input service and inputs. Now, department comes for audit or adjudication process starts or whatever it is. They say that, look, you claimed 5%, but you claimed ITC. Since you claimed ITC, you are no longer eligible for 5%. Then what will follow? 18% will follow. So the effect is that 18% becomes a possibility with ITC is what I'm trying to suggest in the terms of this interpretation. And the advantage would be that undivided share would not be liable to GST. Now coming to the next topic, which is the 1/3 deduction. Now let's understand this philosophy of GST. GST is a levy on goods and services, not on land. Some of you who would have been in service tax regime in the real estate sector, and some of you would have been in the VAT regime and the service tax regime, would have paid VAT under works contract categories in VAT law. And for service tax, you would have called it either construction of complex services or works contract services. If you had called it construction of complex services, there was a notification that says that we'll give you abatement. Now, why did they give you abatement? They gave you abatement because goods could not be taxed, and they had to give an abatement for that. In works contract, 40% of the value was taxed, 60% was knocked off, 60% was attributable to goods. The same philosophy is kind of brought in here, whereby the law is very clear that we can tax you only goods and services. Land should not be taxed. So how do we eliminate land? And that is how that 1/3 deduction was born in the notification. So let's look at an example. Land considerations would be 10,000 per square feet. Construction consideration is about 5,000 per square feet. Your total is about 15,000. So if you get a deduction towards land at 1/3, your taxable value becomes 10,000 rupees per square feet. So when you're paying GST on 10,000 rupees per square feet, you're actually paying on construction, but also on land. Some element of the land consideration is also sitting in because of this artificial 1/3 deduction when your actual land value is higher than this 1/3 notional value. So the question that begs to be addressed is, can the assessee adopt the land value on actual basis since it is more beneficial to him? Now, if you look at the decisions that flow in the context of options in Wipro is a very famous decision in customs, where if you import certain goods, when the goods land into the country, after the FOB value, you will have to add the freight, you'll have to add the insurance, etc. to get the CIF. So basically, on the landed goods, you add freight, you add insurance, you also add handling charges. Now, the customs valuation rule said that take the freight if it is ascertainable. If it is not ascertainable, take a certain percentage. Take the insurance. If it is not ascertainable, take a certain percentage. And then it said, take 1% of handling charges. So the ascertainable point was missing as far as handling is concerned. Matter went to Supreme Court. Supreme Court said that it is always available as an option to the assessee to say that I have handling charges data which is ascertainable. I'm not bound by this 1% formula. Same analogy can be extended to say that I have actual land value which is much, much higher than the 1/3, and therefore I want to exclude that value. And that found acceptance in GST before the Gujarat High Court. In Munjalal Manish Bhai Bhatt versus UI, Gujarat High Court has very clearly analyzed the provision and then said that there is no legislative intent to impose tax on construction activity undertaken by a supplier that has person to the legislature is never to tax the land. It is always to tax the construction services. And therefore, if there is a specific consideration agreed for sale of land and for construction, the specific value of land can be taken. And then they went on to say, where the statutory provision requires valuation in accordance with the actual price for the service and an actual price is available, then tax should be imposed on actual value. Now, this gives you clear and cogent answer to say that if the parties to the contract are aware as to what is the consideration for the construction activity, then that is the one that can be taxed. You cannot substitute a deemed value or a deemed fiction, because deemed fiction can come in only when actual value is not ascertainable. Para 2 of the notification, which provides for a mandatory fixed reduction of 1/3 towards value of land, is ultra vires the provisions of the Act as well as the scheme. Application of such mandatory uniform rate is discriminatory, arbitrary, and violate of Article 14. And therefore, they read down by saying that, in our view, while maintaining mandatory reduction of 1/3 for value is not sustainable in cases where land can be actually varied, you can always have the option to say, I'll sort of the actual value. Now, this decision clearly indicates that land value can be actual basis where it is ascertainable. Now, what do you mean by ascertainable? You have data. In any number of cases, the land is the one that always has the data. You have a price, and there can be a bargain between the parties as to what is the land value which can be transacted between them. Of course, subject to what is the guideline value, stamp duty purposes. Now, same analogy can apply when para 2 is applied in different parts of the notification. If you look at the entire notification, 11/17 as amended by 3/19, you have para 2, which talks about this 1/3 deduction. This para 2 is applied in so many places. It is applied in the context of development rights. It is applied in the context of construction for landowner. So wherever it is possible, you can apply this decision to say that I can do this method. In fact, this judgment is also very, very interesting, because it also says that in respect of landowner, in respect of valuation, even cost plus 10 method is also a possibility for construction services, which I'll discuss a bit later when I come to joint development agreements. First burning issue throughout the country is joint development agreement signed before 1/7/2017. So let's understand this baby. So there is A, who owns land, and there is B, who is a developer. A is not able to sell the land. A is not able to market the land. It's too pricey, too difficult to handle for him. It's a vast piece of land. And B comes in and says, look, I want the land, but I can't pay you for the money. So let's enter into a joint development agreement. So they enter into a joint development agreement whereby A executes the agreement, confers power on the developer to develop the property, gives him right to enter the property, gives him possession of the land, hands over some of the document, hands over the title documents pertaining to the land, and the entire bargain between the parties is that B shall develop the project. Let us say 100 apartments are constructed. Out of the 100 apartments that are constructed, 40 will belong to landowner as landowner share, 60 will belong to the developer as developer share. Landowner can do whatever he wants with the 40, developer can do whatever he wants with the 60, and for that purpose, whatever documentation required will be executed between the parties. Each state has got its own requirement for the documentation. Therefore, I'm not going too much into the documentation format. In some states, even the joint development agreement itself is a registrable document for stamp duty purposes. That's even better case. Therefore, when you have signed the joint development agreement before 1/7/2017 and the project has suffered delays, and now you are actually implementing the JDA after various disputes and rearrangements, the 40, 60 become 45, 55, or whatever it is, supplementary agreements, etc. You are still executing part and parcel of a bargain which was signed before 1/7/2017. So under a joint development agreements, from the landowner, what all comes? He gives you land. He gives you right to enter the land. He gives you license to enter the land. He gives you possession of the land. He gives you right to develop the property. And all that has happened before 1/7/2017. So if you perceive that this bundle which comes from the landowner is the consideration for the developer to construct the apartments, the consideration has flown much before 1/7/17. That means it has flown in the service tax regime. If at all this transaction can be taxed, it can be taxed in the service tax regime. It cannot be taxed in the GST regime. And service tax regime period is over. Fire limit is also over. Because if you remember, service tax is on even advances. So even to be provided. Therefore, construction to be provided for which the entire consideration already received. That service is already consummated, closed in the context of tax levies, and it cannot be taxed under GST merely because the execution happens post GST period. So there are some decisions which you can apply in the context of this, the tribunal in the case of Sri Lakshmi promoters, as well as an interesting case of the Karnataka High Court in the case of lease plan, where it was a case where sales tax regime spilled over to VAT, or sales tax regime was, repealed and VAT was introduced. Lease agreements were signed during sales tax regime. When the rentals became payable during VAT regime, the authorities demanded VAT on the ground that rentals are payable in VAT regime. The Karnataka High Court said that, look, the transfer of right to use goods has happened during sales tax regime. There is no fresh transfer of right to use goods in the VAT regime for VAT to apply. Same analogy would apply here also. So 4/18, 6/19 cannot even apply when the development rights had moved earlier, that is prior to 1/7/2017. So that sets apart the first dispute. Now let's go to the second dispute, which is, let us assume that all joint development agreements have been signed after 1/4/19 when the new regime is in place. So different models exist. Let's assume we get to the same model of 100 apartments. And the parties sign saying that, look, let's have a joint development. You build the 100 apartments or 100 units. You sell everything in the market yourself. You market, you advertise, you take all the risk, you insure everything you sell. As and when money hits your bank account, every 1 rupee that hits your bank account, I need 40% of that. So it's a revenue share model whereby money flows from the developer to the landowner. There is no construction carried out by the developer for the landowner. There is no allocation of constructed area. All the flats are marketed, developed by the builder himself, and only a percentage of revenue is shared with the owner. So this revenue share, can you say it attracts GST? One decision is the Mormugao Port Trust of the Mumbai bench, where it was a case of a revenue share kind of a transaction, where two parties jointly undertook a common enterprise. I'm not trying to say this is a joint venture. I'm trying to say there's a revenue share. There, the court held that there is no service rendered, and the money flow in the name of royalty is not the consideration for rendition of any service, but represents the appellant share of revenue arising out of the venture carried by the parties together. Number of other decisions, cricket club, you have this lot of cases involving IPL. Recently, we also won in the context of the Chennai IPL, where there is a broadcasting right revenue that is shared between BCCI and the various IPL players. So IPL companies, teams, all that has been consistently held to be revenue share and not taxable. So revenue share is well settled as far as decisions are concerned in service tax, as well as, over a period of time, it has been observed that if the transaction can be demonstrated as a revenue share, there is no question of inter se rendition of service between the parties. So you can apply the same model for, joint development and say that this is a revenue share kind of a transaction. You have to be careful in drafting your joint development agreement. You have to ensure that you don't land up as an AOP for the purpose of income tax, and therefore care should be taken in ensuring that the clauses are adequately drafted. The next model in joint development is what we call as an area share model. So in this area share model, as I gave you the first example, 100 apartments are constructed, and out of the 100 apartments, 60 apartments are to the developer's share, 40 apartments are to the owner's share, which means owner can market sell the 40, developer can market sell the 60. So the questions would be, is the developer liable to pay GST on construction done for the landowner? Can it be said that there is a supply of service by the developer to the landowner? Can it be said that since the cost of construction pertaining to owner share has been captured in the selling rate, there cannot be any further linkage? Let's look at common sense logic here. Now, I'm a developer. The landowner has given me the land, has given me possession, has given me power, and asked me to develop. I build 100 apartments with my own money, and I give 40 apartments to the owner. Now, when I'm giving away 40 apartments to the owner, there's a cost involved in creating those 40 apartments. There's a cost of construction of that 40 apartments. Where do I collect that from? Since I'm not collecting it from the owner, I build the cost, I load the cost of construction into my selling rate for the 60 apartments. Therefore, when I arrive at my cost construction statement for the selling rate to be marketed for the 60 apartments, I factor all the costs, including the costs incurred for the owner. Therefore, when I pay GST on the 60 apartments that I'm marketing, I'm actually paying on 100 apartments because I'm factoring that cost also by fixing at the selling price. This is the view in the context of service tax by the Hyderabad bench of the tribunal in the case of Vasanta Green, where it was very clearly held that that cost has been captured, and therefore, since that cost has been captured, that consideration has been captured, and service tax has already been discharged on the entire apartments. And that was again followed by the Hyderabad bench in the case of PNR Infra, which said that there is no question of service tax again. You can apply that rationale to this, but of course, with its own baggage and degree of litigation. The second view would be, of course, the primary view would be, I don't want to take all these risks. I will go by notification 3/19. What does 3/19 ask me to do? 3/19 asks me to do something interesting. It says, find out your first selling rate. So first booking rate. So developer has got a first booking rate, and that first booking rate would be applied to the construction which is carried out for the landowners. Now that would mean, please understand that it would factor so many other costs which are irrelevant to the owner. The selling rate of my apartment covers my overall project cost, my financing cost, my advertisement cost, my sales promotion cost, my compliance cost, my overheads, my branding. All those things are all captured in my ultimate selling price to a customer, whereas including the land cost. Whereas the landowner is already the owner of the land, and all he gets is apartments for the purpose of, or for in pursuant of the joint development agreement. So he gets only the apartment. He already owns the land, and he doesn't get any benefit of those advertising, promotion, etc. because it is right which flows from the contract. There need not be an advertisement for him to get these apartments. Therefore, whether that selling rate is a relevant rate, if you ask that question, then you look at these other options, whereby you can look at Fakir Chand, where Fakir Chand, very literally, what is Fakir Chand's case? It's a consumer dispute case, where one of the dispute before the Supreme Court was whether a developer is a service provider, whether a landowner is a consumer. Supreme Court said developer is a service provider, landowner is a consumer. And Supreme Court also said the service that is rendered is backed by consideration in the form that is given up by way of land. So 100 apartments, landowner says you sell 60. That means the underlying land for the 60 is given up by the owner, and is giving that up for the purpose of getting 40 apartments. Therefore, land given up by the owner is actually the consideration for the 40 that is constructed for the owner. And that is probably matching what is called the requirement of consideration, because supply must be for consideration. And if you perceive that as a consideration, then you have a figure called as value of land. So coming to what notification says, 4/2018, all of you are aware of how this notification operates and how it talks about who should pay the tax on development rights and whatnot. I'll go to 6/2019. Notification has been issued under 148, and it says that the following categories of persons have been identified as persons liable to pay GST. Promoter who receives development rights after 1/4/19 for construction of a project against consideration payable by him in whole or part of construction services. And then it talks about liability at what point of time, etc. Interesting questions could be whether 6/19 and 4/18 are valid, because both of them have been issued under 148. If you look at 148 talks about registration, furnishing of returns, payment of tax, and administration of tax of persons. For these four categories, there can be some modifications, concessions, etc. For example, you can say file quarterly returns or half-yearly returns instead of that, or you can give an installment in payment of tax, or you can say who should administer whom, or you can talk about some registration. That is the power which you can exercise under 148. Can you go beyond that and specify categories of taxability? Can you under 148 say that the developer has to pay GST on the construction carried out for the owner? Can you under 148 declare a taxable event, saying that a joint development creates a tax liability? How do you create a tax liability? There has to be a supply. Can you deem a supply through a 148 notification? So that begs the question as to the validity of notification under 148. So if you go by the notification 4/18 and 6/19 and say that, look, I want to go by what is there in the notifications, then your only choice would be a comparable rate. So a comparable rate you pick from the market and you apply that comparable rate. And if you apply that comparable rate and you charge the landowner GST, then this picture gives you the indication of what's going to happen. Today, everywhere in the country, landowners and developers are at loggerheads with each other. Both of them don't see eye to eye when it comes to GST. Why? Because the developer has no qualms in collecting the GST from the landowner, because after all, GST is a pass-through tax. It's an indirect tax. You pass it on to somebody. I don't want to fight your battle. I'll collect it from you. Perfectly right. But you have to be very careful because the agreement is critical. Sometimes what happens is the joint development agreements, in most cases, I've seen, are silent on GST. Or they're very vaguely drafted on GST. Both parties shall bear their respective GST liabilities. What do you mean by that? Or it says both the developer shall be entitled to collect VAT from the builder, drafted from the owner, drafted long back, no amendments. So first important rule for a developer is if he is entering into a joint development agreement, he must ensure that he meets the commercial requirements, he meets the landowner requirements, he meets the RERA requirements, and he meets the income tax requirements, and he meets the GST requirements. So if he is clear that I don't want any chakkar of litigation, I would like to borrow the rate that is available and collect the tax from the customer, specify it very clearly in the joint development agreement. So that is one view. The second view would be, look, I'm not in a position to collect GST from the customer because my agreement is silent, and therefore, customer is refusing, owner is refusing. How do I take a position in terms of the quantum of GST? There, these options could come into play. You can probably say that I'll adopt land value as one of the methodologies, or if there can be an agreement between the parties on what is the agreed rate. Or another beautiful method, you can get a clue from Gujarat High Court, is that why not take a position or examine a position that if consideration is ascertainable, consideration is unascertainable, two different scenarios. In a joint development agreement, the value of the development rights is not known. Development rights is never measured in terms of selling rate of apartments. FSI is not calculated based on the guideline value of apartments or the saleability of apartments. FSI is a species by itself. TDR is a species by itself. Therefore, if there is a difficulty in ascertaining the value for the development rights, then you go to the rules. And if you go to the valuation rules, one of the best rules that is given is cost plus 10%. So if consideration is not ascertainable, and let's take this, let's take this ball a little more and roll it. Joint development agreement, 40 apartments for the owner, 60 apartments for the builder. For the 40 apartments, I have to pay GST because I have constructed for the owner. And for this development rights, there is a reverse charge mechanism. And for that, they say, take the selling rate. Now, can you take the selling rate? Because are they comparable? Because even if you go by the rules, it talks about open market value. Can you say that open market value is the first selling rate for this? Because the apartments are not positioned in the same format. For the apartment of 40 apartments for the owner, it is only the construction that is given to him. Land is already owned by him. Please remember, for a landowner, land is already owned by him. For a customer, he gets the apartment as well as the undivided share of land. And therefore, can you say that X plus Y can be compared with X? If both of them are not comparable, then your open market value, like value, all of them collapses. If all of them collapses, you come down further to the rules, you come to cost plus 10%. So value can be cost plus construction cost plus 10%. And that is one of the options which is available. Of course, no tax position will be a very hyper-aggressive position, which can land to a high degree of litigation. But if you're discharging GST, you can also look at the options. Of course, from a policy perspective, it's high time the GST Council debates this issue, because across the country, disputes are so much because the GST amount to be recovered from the owner is sometimes equivalent to the flat that has to be sold to repay this amount. And therefore, landowner blindly refuses, saying, I will not pay GST. And there are disputes between the parties as to what should be the quantum of GST, and the matter goes to arbitration in some cases. So why not look at it holistically again and arrive at some other better solution to tax this kind of a transaction? Why not legitimize this cost plus 10% in the special rule itself? Why not create one more rule if required to say that for joint development agreements, the value can be cost plus 10% at the option of the assessor? So that can at least solve so many other issues. And in going forward, it can be easier in terms of taxing joint development agreements. Now coming to development rights. Now, development rights for residential projects, there is no GST through an exemption notification subject to various conditions, but with a catch which says that when completion certificate is obtained and there are unbooked units, promoter has to pay GST on development rights under RCM at 18%. Now, what is this liability? First of all, it is on the developer. Secondly, it is on RCM basis. Thirdly, it is contingent upon the project getting completed and you getting a completion certificate or a first occupation happening. Fourthly, you need to quantify it based on unbooked apartments that are available. Now, please understand, the 40 apartments that are to be given to the owner are already booked. You cannot give to anybody else. So we're talking about the 60 that is available to you. In that 60, suppose you have marketed and booked about 50. You're talking about unbooked area of about 10. And that, based on that formula, you'll have to discharge GST under RCM basis. But look at the valuation methodology. Promoter is liable to pay GST on development rights, and the value shall be deemed to be equal value of similar apartments charged by the promoter from independent buyers. How can the value of similar apartments be the same as development rights? So that itself gives some kind of a disconnect. So one view would be, can you even tax development rights? Can you consider development rights as immovable property? For you to consider development rights as immovable property, you go to the definition of immovable property, and there it says benefits attached to land. One popular argument to counter this would be to say, look, third schedule refers only to land. Third schedule does not refer to immovable property. Does it mean that immovable property can be taxed? If that is the case, then there is no necessity for stamp duty and registration fee. There is no ST for entry 49. GST is all encompassing, all pervasive. In fact, there is an interesting observation in the Supreme Court judge in the case of VKC Footsteps. In VKC Footsteps, while the dispute was on inverted structure and the refund, etc., one of the petition contentions was that the council must be given a direction. Supreme Court said that, can we direct the council to levy GST on alcohol, petroleum, and real estate transactions? No, we cannot. What does it mean? It means that real estate transactions, alcohol, petroleum, are well perceived to be outside GST. Some years back, when Mr. Jaitley was alive, when he was a finance minister, he was talking about real estate transactions to be brought into GST, which means it is not there in GST. People are talking about bringing it into GST. If that be the case, if a joint development agreement which involves development rights, and development rights are perceived as immovable property, and the stamp authorities levy stamp duty on the transaction under the powers available on that entry, can you ignore that? Secondly, if you say that no, both are possible, we'll apply this, aspect theory, some aspect we can tax, some aspect we cannot tax, then you cannot tax the entire value. Then you must eliminate the value and identify only the service value, which is not there. If that is not there, it collapses. Computation mechanism fails, the levy itself fails. Therefore, one view would be to say that if it is immovable property, then it will be difficult to tax development rights. Second argument, for development rights to be taxed, it must be a supply. For it to be a supply, it must be in the course or furtherance of business. Can you say that the landowner is engaged in supplying development rights on a regular basis as part of his business activity? If the answer is no, then it is not even a supply. If it is not even a supply, can you apply RCM? So that would be the question that would follow to say that it is not in the course or furtherance of business. In fact, there is a very nice wealth tax judgment where there was a transaction where the parties entered into a joint agreement and they decide to carry on the activity. They decide to enter a JDA and land would be put in. So one of the arguments was that, look, I've signed a joint agreement, therefore it's my stock and trade. And since it's in my stock and trade, it is no longer liable to wealth tax. It was rejected, saying that it is an isolated transaction. You cannot call it as a stock and trade. So it is not business. The selling rate for a customer is to be identified as a tool for valuation. Can it be applied given the fact that development rights are not measured in terms of square feet? The selling rate would include land, and the owner is not conferring development rights in respect of retained land. Please remember, he is not giving any rights for retained land. He is only giving rights for the 60% portion. Now, let us assume that the market is quite bad. There is no selling rate. Or given a situation where both parties have agreed that the entire thing will be lease model. whereby the owner and the landowner agrees that, look, I'll construct 40, I'll construct 100, 40, you also lease out, 60, I'll also lease out. So when the nature of the agreement as well as the parties very clear that the entire units will not be sold but leased out, where is the question of selling rate? There is no available selling rate. If there is no available selling rate, how do you adopt that valuation? What the owner provides is a right to sell UDS as well as the right to develop. So when you say that he's giving development rights, he's not only giving development rights, he's giving you development rights, he's giving you possession, he's giving you right to enter the property, he's giving you license to enter the property, he's giving you power to develop the property, he's giving you power to market the UDS. All this is a package in the joint development agreements. But can you say that what is taxable? The entire development rights is the only one involved. If computation mechanism fails, then the levy fails. You can always fall back on DC Srinivasa Setty's decision. So development rights, one, no tax position. Otherwise, you go by the notification. You have computation challenges. You have possible changes in the future. And of course, you have to pay GST on RCM basis, and there's no ITC that is available. The next segment in real estate is the plots. First model. Developer develops the land into plots and is selling plots. This is the typical scenario. And for this, what does he do? He buys land from the owner. Land is then developed into plots. What do you mean by development of plots? The land could be barren land could be, up and down. It could be of different heights. There could be a water stream. There could be some other leakages. There could be underground water spillage into it. So some grouting has to be done. Some sealing has to be done. Some leveling has to be done. And then you have to lay sewer lines. You have to lay power lines. You have to lay, roads. You have to give a common segment for the local municipality for parks, etc. All that is done as part and parcel of activities to make the product even more attractive and into plots. So the department felt that this activity is something new and plot is different from land. Of course, that was ultimately clarified by the board. So first model, land purchased, land developed into plots, developer sells the plots. Second model, developer and landowner enters into JDA. Land is developed by the developer. And then, as per their agreement, look, we have developed into 100 plots. You sell 40, I will sell 60. So, as and when market comes, the landowner sells his plots or his share of land. As and when market comes, the developer sells his plot of share of plots. Third model, developer and landowner enter into JDA. Developer sells all the plots, makes the money, and then shares the revenue with the owner, somewhat similar to the first model we discussed. Now, what does the board circular say? Board circular says that land may be sold either as it is or after some development such as leveling, laying down drainage lines, water lines, electricity lines, etc. It is clarified that such sale of developed plot is also sale of land and is covered by entry 5 of Schedule 3 of the GST Act, and accordingly does not attract GST. However, it may be noted that any services provided for development of land like leveling, laying of drainage lines, etc., as may be received by the developers shall attract GST. Now, they're talking about vendors. They're talking about vendors to the developers who provide these services, and they may charge GST at applicable rates. They're not talking about development rates per se, development charges per se becoming taxable. So what would you conclude? You will conclude by saying that I am selling plots. If I am selling plots, the sale of plot is nothing but sale of land. I will pay applicable stamp duty registration. And in the both models, when I sell the entire plots, or in a model where the landowner sells 40 plots and I sell 60 plots, there is no question of any GST. When the developer sells all the 100 plots and shares the revenue, it becomes a revenue sharing arrangement. You also have to be careful as to what is the position you're taking in income tax. Because income tax for the landowner, there is a capital gains issue. So when does his capital gains arise as far as the plot is concerned? As far as the joint development agreement is concerned, where an individual has entered or a HUF has entered into a joint development agreement with a developer for the purpose of developing a complex, etc., income tax has got a special provision whereby it postpones the capital gains liability to the year in which completion certificate is issued. But for plots, there is a different kind of a scenario. In the case of a plots, you will have to understand what is the income tax position which is adopted by the landowner and probably sail along with that in terms of when you recognize the transfer. Now, third situation, I have a development done by me. I enter into a sale deed for, let us say, 2,000 rupees per square feet. And that's matching the guideline value for stamp duty purposes. Then I enter into a separate agreement with my own customer, calling it as development agreement, and charge 1,000 rupees per square feet. Now, a lot of people have started this model for two reasons. One, they feel that it is impossible to register 3,000 rupees because of local pressures. This is very peculiar. Land and real estate is very peculiar because what you want to do, sometimes you cannot do. You want to pay stamp duty on 3,000 rupees. There could be scenarios where you will not be allowed to register because the market is frozen at 2,000. So 2,000 rupees you register for stamp duty purpose. It is well above the guideline value and accepted. And 1,000 you go for development charges. And the next question comes is whether GST is applicable separately on 1,000 rupees. One view would be to say, look, principal supply is sale of land. This development charge is nothing but incidental to sale of land. Therefore, it is a composite supply. It takes the color of the land and therefore not taxable. That is one view. Another view would be to say, look, this development service is a separate service by itself. I want to charge 18% GST on 1,000 rupees. Plus, my vendors are all charging me GST on the subcontract services. I want to avail ITC on that. So I would like to do that. So some developers go for this model, some developers go for that model, depending upon what you want to do and how you want to do it. But the point remains that it is always open to you to actually fix the entire value of sale of land by 3,000 rupees and paying stamp duty on the transaction if it is feasible and practical and possible. When you charge development charges separately, whether service tax can be imposed, that came before the Chennai bench, the case of Hallmark Infrastructure. The tribunal accepted the arguments and said that development activities are undertaken before sale of land, and hence it's a self-service, and there is no service provider service recipient relationship. And therefore, without development, the plot is not really marketable, and therefore development is critical for the plots to be identified as a market plot. This will also help your composite supply argument. The last topic I'll take for the day and then open up for questions. Slum redevelopment. In some states, it's very popular. Maharashtra is extremely popular. In a typical slum development project, the land would belong to the government or the municipality. The developer would be given the contract to construct units for the slum dwellers as per the terms of the contract. The consideration would be TDR or FSI, which can be used by the developer in another building. So what in effect happens is that the developer is called upon to construct units for the existing slum dwellers, better units, better infrastructure, better amenities, etc., as per plan, as per specification, as per the policies. And instead of paying them money, the municipality decides to give them development rights, TDR or FSI. Now, this TDR or FSI can be dealt by them. They will use it for another building for higher FSI, or they may even market this. Now, the law is very clear. There is a levy of GST on supply for consideration. Is there a supply of service? The answer is yes. There is a construction service provided by the developer. And he is providing the service on land which does not belong to him. The land belongs to the authority, SRA. The land is not parted. It's only given, you are only given a right to develop it. The ownership of the land remains with the government or the municipality or the SRA. And therefore, at best, one can take a view that the developer is operating like a contractor. If he's operating like a contractor, he's executing what is called as construction services and putting up units, for which instead of a monetary consideration, he's given a non-monetary consideration in the form of TDR. So some of the observations of the Bombay High Court and Samar Corporation can be used, where the Bombay High Court said that TDR is a measurable benefit and therefore would constitute consideration for carrying out construction work for SRA, and the transaction nothing but a works contract. So if it's a works contract, you get into 18% category. So as the consideration does not involve money, the open market value can be only the amounts paid to similar contractor for carrying out identical work. So if that can be identified from the PW rates or other lower rates available for the slum SRA purposes, that can be adopted. So the general contract rate awarded by SRA to contractors for construction of slum rehab buildings involving the same quality of materials will become the comparable value for the purpose of valuation. And on that, you can pay the GST at 18% and also avail the ITC. This should not be confused with 3/19. 3/19 does not even come into the picture because 3/19 necessarily involves land as well as the construction to be given together as a parcel to the consumer. Whereas in this case, land is never given as a parcel because land already belongs to SRA. What they get is only the units. They are already owners of the land through the SRA. So that I think is my last slide. Last slide for the day would be, what are the other issues faced by real estate sector? One, the anti-profiting authority, which is now the Competition Commission. Biggest challenge faced by real estate is this. All kinds of complaints have been filed and action has been taken. Orders have been passed, matters in courts. We are also before in multiple courts on this. the question that is raised is, how do you define benefit of ITC being passed on? Now let's take a developer, the poor developer. No ITC to be availed. No ITC can be availed. Whatever you availed in the past will go. Whatever you transited, whatever you currently avail, whatever is sitting in your books, as soon as you get your CC, you must reverse Rule 42 because CC has come. If that be the case, there is a question of passing on benefit of ITC from a developer to a consumer. There is the ITC to pass on. There is no ITC to pass on. A person who is operating under the 5% regime is not allowed to take ITC, and whatever ITC it takes also, there are mechanisms to reverse them based on CC. Whether that has to be done is separate, but for anti-profiteering purpose, I don't have anything to give away. Number one. Number two, what is this benefit of ITC that is not quantified? The rules are very silent on what is the benefit of ITC for any industry. For construction, even more peculiar. When assuming I'm entitled to ITC, what happens? Do I escape from paying my cement vendor that amount? No. I have to pay the cement value as well as 28%. Do I escape from paying the vendor of steel, the GST portion? No. I must pay the steel value plus the GST portion. So what do I get of ITC? In my computation, through accounting entries, the GST which is paid to the vendor is not forming part of my cost. It goes and sits in a GST credit account. It is available for set off when I have GST liability. So what is the real benefit of ITC? In my view, the real benefit of ITC is not the entire amount of ITC, but the cash flow benefit or the savings in interest cost that I get. To the extent of ITC obtained and to the extent of loans that I don't take because of the ITC to pay the GST, especially taking into account what is the period of which I collect the GST from the customer. That is a credit period. On that, if you take a notional interest, that is the real benefit of ITC that one may have to pass on, not the entire ITC. Second issue, reconciliation. As per accounting standard, as per Ind AS, I have to do construction completion method, which means I can account the project, I can account the profits from the transaction, I can account the billing from the transaction only when the construction is completed. But GST says I have to pay GST as and when I receive advances. Therefore, necessarily there will be differences between my tax returns and my financial statements. And therefore, there will be reconciliation issues. These reconciliation is inherent by its nature. But unfortunately, across the country, show cause notices are issued saying that you have unbilled revenues. Why didn't you pay GST? Unbilled revenue means my right to raise a bill on the client has not yet happened. My work has happened. Therefore, I've reported it. But my agreement says I should bill only on this date. Till that date happens, I cannot raise a bill. That is called unbilled revenue. Can you levy GST on that? Answer is no. Enough decisions from service tax period. But those are all challenges which a developer faces. Third, CC comes in. Completion certificate. Some states call it occupancy certificate. Some states don't even give a certificate. So when I get a certificate like that, there are rules which say that I must reverse all my ITs. Is that correct? The ITC availed prior to 1419 was availed at a point of time when the notification allowed ITC without any condition. Can you read that new condition into ITC? Eligibility test for ITC was met when I availed. It is not a concurrent or a regular test. I don't have to prove eligibility till the end of my period or my project. My eligibility is the first time, whether inputs are used in the course or furtherance of business or intent to be used in the course of furtherance of business. Met. 16 two conditions met. Satisfied. Therefore, I cannot be called upon to reverse my SENVAT credits and VAT credits on the ground that they are all prior to 1490. What is the scope of unbooked units is again a matter of interpretation as to what is allotment, what is unbooked, etc., and whether the landowner's area can be considered as booked or unbooked. So as I said earlier, drafting of JDA is very, very important. You have to be careful on ensuring that all aspects are covered. Biggest challenge would be customers' understanding of GST. Therefore, if you're signing a new JDA with the landowner, sit with the landowner, explain to him that this would be the quantum of GST. and put it in the agreement in terms of computation mechanisms, etc. Because later on, mind you, it's a stuck situation. You cannot move this way or that way. Biggest challenge today in GST is that if a customer is unhappy, he can go to RERA. RERA gives him all the rights, RERA gives him all the powers. So their understanding of joint development agreement is also very different. And therefore, they go to RERA saying that I should not be called upon to pay GST. Give me an order saying that no GST can be collected from me. So that another interpretation before RERA as to whether GST is applicable or not. Ideally, what should happen in the future? This 5% is not the best system. But a lot of people say that 5% is convenient because the rates in some parts of the country are very, very high. So if we can't afford to, pay a 12% GST. So why not have this option of whoever wants to charge 5% without ITC, let them pay. Second option, give 12% with ITC or 8% with ITC. There is already enough categories like that. Your motor vehicle has it, your GTA has it. You have with ITC, without ITC option. The same logic can be extended here. See, this 5% philosophy is fine for restaurants, at least small hotels and restaurants, because there it's a B2C business. And in a B2C business, like a small hotel or a small restaurant, the requirement for a hotel for ITC was not significant. Vegetables are exempted, meat is exempted, food is exempted, most of the raw materials are exempted, only oil probably will get taxed, rental small amounts will get taxed. So the requirement of ITC was not big, and therefore they could afford to accept the 5% GST on hotel billing. Small and medium levels. Higher, bigger hotels will always say we want more ITC. So there's a case for option. But that 5% model was simply replicated to construction, saying that you all charge 5%, without understanding that there is a case for an ITC, because you're indirectly, even though you're saying I'm benefiting the customer, your selling price goes up because cement is at 28%, straight cost. Your biggest chunk is cement. So one view going forward is there must be an optional GST rate with ITC. And probably future, you may have to merge stamp duty and registration to GST. That would require a constitutional amendment, and that can happen at some point of time. And tax on land should not be there, or if they want to bring tax on land, they have to bring it properly through a constitutional amendment and delete entry 49 and cover article 246A to cover land also. With that, I've completed my session. I have about 5 minutes available for questions. So let me look into the chat box and see if there are any questions which I can pick up. In the case of redevelopment of tenancy building, are tenants supposed to pay GST to builders? See, whether it is a tenancy building or the building under SRA, or a situation where existing owners all join together and come up with a redevelopment program, the question would be, what are the rights intersect? So if the owners are all tenants, the question would be how can they transfer title to the ultimate buyers? Because you must be a owner to transfer further ownership. If you yourself are a tenant, can you transfer title to that land? The answer is no. So I presume you're talking about adverse possession, and that gives some rights. That's a separate topic by itself. We have to discuss it offline. Construction on leased land, does the 1/3 deduction available? Now, as far as 1/3 deduction is concerned, it talks about the selling rate. So there is a selling rate, and the selling rate necessarily, when the language used is, it is the consideration which includes the construction as well as a sale of undivided share of land. So if there is no sale of undivided share of land, then it is only a construction service per se provided. So let us say it is a transaction where the land is on lease, you got on 99 years lease, and therefore you have rights to give some more rights pertaining to the land to your next customer. You will have to then analyze the scope of 6/2019 and then apply that language used there, because they also talk about a long-term lease there. So if some part of long-term lease is also perceived as a consideration flowing from the landowner, then you will have implications under 6/19. Otherwise, if it's a pure, simple vanilla lease whereby the land is belonging to a lessor and he continues to collect rent on that land, but he allows you to construct and allow somebody else to use the constructed area, then it is a case of lease of building and lease of land, which is separately. It's not an easy proposition, but it depends upon who gives the land, whether it is a government agency or a private party. Depending on that, we can look at the transaction. Taking office on lease and further leasing it, can it be taken as lease paid? Yes, you can take an office on lease, pay the GST, and then lease it further and pay the GST and set it off. It will be a normal lease kind of a transaction, because 17(5) comes into play only when you are using input services for construction of immovable property. You are not using any input services for construction of an immovable property, and therefore it is not a block rent. What will be the ideal valuation method to charge GST to the landowner in case of JDA of residential apartments and when it is due? So if it is a case where you have signed the JDA and you are very clear that you can collect the GST from the customer, and the GST is not a very big quantum when you compare when you calculate the GST as per 3/19, then that can be the comparative rate, can be the basis. But if your JDA is silent, or you're having disputes in collecting GST from the landowner, or if it's a case where both parties are in a position to look at it differently, then you can look at the Gujarat High Court options given in the context of valuation, apply that, and look at whether cost construction can be a basis. 110% of cost. I think that completes the questions. Thank you. Oh, there's one more question that's come up. Kindly do a session on construction on leased land. Maybe sometime. If Taxmann is listening, we can look at some options. Can landowner take ITC? Landowner taking ITC depends upon two factors. One, he is also identified as a promoter, landowner promoter. He also markets the units which are given to him by the developer. He must sell and pay GST at a rate or an amount which is not less than what the developer has charged him. And if all this happens before completion certificate, yes. But after completion, it doesn't make sense at all. Time of supply would be governed by the contract, because it's a continuous supply of service. Therefore, you can specify the time of supply. You can specify the due dates payable for the contract itself. For example, a lot of people say that you pay 10% advance when the foundation is done, 15% when the first floor is completed, 10% the second floor is completed. They are nothing but events which are specifying in your continuous supply of contract, and that would be the trigger point for raising invoice and paying GST. Any other questions? We'll stop the meeting otherwise. Taxman? Supplier has to raise invoice receipt-wise in installments. Many developers are not aware of this, but the time of supply requires you to raise an invoice based on your continuous supply of services. Therefore, if your trigger point is installment, then you are bound to raise invoices on the customer.